Let's begin with a mental picture. Imagine two titans standing on a global stage, their muscles tensed, eyes locked. Everyone in the audience is staring at their fists, waiting for the first punch to be thrown. They're watching the warships, counting the fighter jets, analyzing the angry speeches. This is what you're supposed to see. It's the theater of geopolitics, designed to hold your attention. But if you want to know what happens next, you must stop looking at the stage. You must look underneath it. You must listen to the slow, heavy, grinding sounds behind the curtain, because while the actors perform, the stagehands are moving the foundations. And in our modern world, the single heaviest foundation, the true bedrock of global power, isn't an army, it's debt, sovereign debt. Specifically, the debt of the United States of America. For decades, the US Treasury bond has been more than an investment, it's been the gravity that holds the financial universe together. It's what banks use as ultimate collateral. It's where nations park their life savings. It is the default, risk-free asset. But what happens when the second most powerful player in the game decides that this asset is no longer safe? What happens when they don't just doubt it, but actively, urgently, want to get as far away from it as possible? This isn't a financial story. This is a detective story. The clues aren't in troop movements or diplomatic cables. They're in the driest, most boring government reports imaginable, pages of numbers that most analysts skim and ignore. But buried in those numbers is a signal so clear, so deliberate, that once you see it, you cannot unsee it. China, America's great rival, is conducting the largest financial exit in modern history. They are unwinding a partnership that defined the 21st century. They are selling their holdings of US debt at a pace and under conditions that defy all logic of profit and loss. They are, in the cold, clinical language of finance, clearing the decks. When a superpower does this, they are not rebalancing a portfolio. They are preparing for a world where the old rules no longer apply. They are preparing for a divorce. And in the history of nations, divorce is never quiet, and it is never cheap. My name is not important, but you can call me the archivist. My job is to read the footnotes the world misses. Tonight, we are going to read them together. So, let's open the ledger. The document is called the Treasury International Capital Report, the TIC. It's published by the US government, and it tells us who in the world is buying and selling American debt. The headline number for October 2025 is this: China's official holdings stand at $688 billion. To the untrained ear, that still sounds like an unimaginable fortune. And it is. But context is everything. You must understand where this number comes from. Rewind to 2013. That was the peak of what economists called chimerica, a forced marriage where China made the goods, America bought them, and China took the dollars it earned and loaned them right back to America by buying its bonds. It was a perfect, closed loop. China's holdings hit $1.32 trillion. They were effectively America's banker. Fast forward to today. That $688 billion figure is the lowest it has been since May 2009. Let that sink in. We have erased 16 years of financial integration. China has sold nearly half of its entire position. They have offloaded over $600 billion of American IOUs. But the sheer size of the exit is only the first clue. The second, more telling clue is the timing. Throughout 2024 and 2025, the US bond market was in a historic slump. When interest rates rise, the price of existing bonds falls. It's a basic rule. During this period, anyone selling US government bonds was selling at a loss. Think about your own finances. If you owned a house and the housing market crashed, you wouldn't sell unless you had absolutely no choice. You needed cash for an emergency, or you were convinced the neighborhood was about to be swallowed by a sinkhole and the house would soon be worthless. China has no cash emergency. Despite its well-publicized domestic troubles, it still runs a massive trade surplus with the world. It is swimming in dollars. So we can rule out desperation. That leaves us with only one logical conclusion. A conclusion that fits the data perfectly, the leadership in Beijing has made a conscious, strategic decision that the US Treasury bond is no longer a safe store of value. In fact, they have come to see it as something far more dangerous, a strategic liability. They are willingly booking billions in losses today. Why? Because they believe holding these bonds tomorrow could cost them everything. This isn't an investment decision, it's an act of financial triage. They are cutting off a limb to save the body. And the event that caused this radical diagnosis happened not in the Pacific, but in Europe. The date was February 2022. Russia invaded Ukraine. The Western response was military and economic, but one financial move echoed in boardrooms and central banks around the world with the force of an earthquake. The United States and European Union, with a few keystrokes, froze approximately $300 billion of the Russian central bank's reserves. These weren't rubles hidden in Moscow. This was money Russia thought was safe. Assets held in the heart of the Western financial system, in New York, London, and Brussels. Overnight, it became inaccessible. It wasn't stolen, but it might as well have been. It was rendered useless. In Beijing, this was not just a news item. It was a horrifying revelation, a nightmare scenario played out in real time. The Chinese Communist Party's strategists would have dissected this event with forensic precision, and the lesson they learned was simple and terrifying. In a confrontation with the West, your wealth is not your own if it sits within their digital walls. Your assets can become hostages. Instantly, your financial power can be neutralized before a single shot is fired. Now, look back at that $688 billion China still holds. In the wake of the Russia sanctions, that money is no longer an asset on Beijing's balance sheet. It is a potential donation to the US Department of Justice. It is a giant, flashing neon sign that says, "Sanction me." The moment a serious crisis erupts over Taiwan or the South China Sea, those digital entries could be frozen just like Russia's. So China is getting out. They are liquidating their position with what we can only call extreme prejudice. They would rather take a 10 or 20% financial loss today, a painful but manageable haircut, than risk a 100% total loss tomorrow. This is the silent, slow-motion financial panic of a superpower. They are not fleeing a failing company. They are evacuating a burning building they helped to build, carrying what they can, accepting the burns, because the alternative is to be trapped inside. This changes everything about the US Treasury bond. It is no longer just a financial instrument. It has become a geopolitical early warning system. The falling number of Chinese holdings is not a ticker tape, it is a countdown tape. And while this silent sell-off is happening, a fascinating unnata thing is occurring in the market. It should be collapsing. But it isn't. Here is the great puzzle. When the second largest holder in the world starts dumping hundreds of billions of dollars of anything, be it bonds, wheat, or vintage cars, the basic laws of economics tell us the price should plummet. Supply floods the market, demand dries up, and the asset becomes cheaper. For bonds, cheaper means higher interest rates. If this were allowed to happen naturally, the exit of China would have sent US borrowing costs soaring. Mortgage rates would spike. The government's interest payments on its colossal debt would become unmanageable. The foundations would shake. But curiously, that hasn't happened. Not yet. The market has been wobbly, but it hasn't broken. Why? Because as one giant player leaves the game, others are being shoved onto the field to take its place. This is where the TIC report gets really interesting. You must look at the WHO. While China's line item is in freefall, others are soaring to bizarre record highs. Specifically, the United Kingdom and Belgium. The UK's holdings have surged to over $750 billion, making it nearly tied with China as America's second-largest foreign creditor. Think about that for a moment. The British economy is a fraction of the size of China's. Britain doesn't have a massive trade surplus, it runs a deficit. So where is this money coming from? It is not excess savings. The evidence suggests the City of London. The UK's financial heart is being used as a shock absorber. Britain is likely leveraging its own financial system, borrowing money, to buy US debt as a geopolitical favour. Then there's Belgium. Its holdings are around $350 billion. Is Belgium suddenly an economic powerhouse? No. Belgium is home to Euroclear, one of the giant, unseen plumbing systems of global finance. When you see spikes in Belgian holdings, it often means other central banks or funds are buying through this Belgian hub, masking their activity. The simultaneous surge in UK and Belgian holdings, perfectly timed to offset China's sales, points to a coordinated political operation. This is the bag-holder alliance. Washington is effectively telling its closest allies China is dumping. If this supply hits the open market, our bond market breaks. If our bond market breaks, the global financial system breaks. And if that happens, we cannot protect you. It is a form of financial conscription. The UK, Europe, and Japan are being asked to cannibalize their own economic strength, to divert capital away from investing in their own futures, to prop up the core of the system. But this strategy has a fatal flaw: capacity. China could buy endlessly because it was the world's factory, earning real dollars from real exports. The Allies do not have this infinite well of cash. They are already straining under their own debt, aging populations, and costly energy transitions. By forcing them to buy US debt, America is draining the life from its own support system. It is weakening the pillars holding up the roof. China knows this. They are playing a brutal game of attrition. Every billion they dump forces the West to find a billion to replace it, exhausting its financial stamina before any physical conflict even begins. The US Treasury bond is thus undergoing a fundamental transformation. It is ceasing to be a true global reserve asset, bought freely by anyone for profit. It is becoming a NATO reserve asset, a club bond held within a political alliance out of necessity, not desire. And clubs, as history shows, can fracture. So, where is all the money going? This is the most critical part of the story, the destination that reveals the true intent. When China sells a US Treasury bond, the transaction settles in US dollars. The People's Bank of China receives a digital credit in an account. But as we've established, Beijing no longer views these dollars as an asset. They are a liability, a digital footprint that leads back to American control. So they are not hoarding the cash. They are executing the most aggressive state-directed commodity grab in modern history. They are trading ephemeral, digital claims for unshakable physical reality. While Western analysts stare at flickering stock tickers, China is loading cargo ships. This isn't commerce, it's a conversion of savings into a war chest. Let's track the money. First, gold. For over 18 consecutive months, China. Central bank has been a relentless, quiet buyer on the global bullion markets. Using the dollars from their bond sales, they are purchasing metal in London and Zurich and shipping it east to their own vaults. Gold is the ultimate anti-dollar. It has no counterparty risk. It sits in your vault, silent and heavy. It cannot be frozen by a sanctions order or devalued by a printing press. By swapping treasury bonds for gold, China is moving its reserves from a system based on trust and credit to one based on collateral you can hold in your hand. Second, energy. China imports most of its oil. This is its greatest strategic weakness. In a conflict, the US Navy could, in theory, blockade the vital sea lanes. China's response? Fill every tank, cavern, and newly built storage facility to the brim. They are buying record amounts of crude, often from nations like Iran and Russia, paying in currencies that bypass the dollar entirely. Satellite imagery shows their strategic petroleum reserves are at or near capacity, with new, massive storage farms under construction. They are building a buffer that could keep their economy running for months, perhaps even years, under a naval siege. The money for this oil? It's coming directly from the liquidation of those American bonds. Third, industrial metals. This is the most telling signal of all. China's domestic property market, which for decades sucked in copper for wiring and pipes, is in a deep freeze. Construction has slowed dramatically, and yet China's imports of copper ore and concentrate remain near all-time highs. This defies all standard economic logic. If you're not building apartments, why do you need so much copper? Because you're building a different kind of infrastructure. You need copper for the green energy grid to reduce dependence on foreign oil. You need copper for the circuitry of drones, for the motors of electric military vehicles, for the munitions of a modern army. China is not stocking up for a consumer boom. It is cornering the physical market for the raw materials of the 21st century military-industrial complex. The same is true for lithium, cobalt, and rare earths. Fourth, food. China feeds a fifth of the world's population with only 7% of its arable land. It's a profound vulnerability. The response has been a quiet, staggering accumulation of grain. According to global agriculture bodies, China now holds an estimated 60 to 70% of the entire world's reserves of corn and wheat. They have stockpiled enough grain to feed their population for well over a year without a single import. They are trading the meager interest yield on a bond for the ultimate currency, calories. This represents a fundamental shift in the mindset of a nation. A country at peace optimizes its wealth for financial return. It chases yield. A country preparing for a rupture, for conflict, for isolation, optimizes its wealth for survival. It chases security. Holding 1 million tons of copper in a warehouse pays no interest. It costs money to store and secure. It has a negative financial yield, but it has an infinite return on survival. When Western economists scoff that China sold its bonds at a loss, they miss the point entirely. Beijing is not playing that game anymore. They are playing a different game entirely. If they sell a bond at an 80-cent loss on the dollar, but use that cash to buy a barrel of oil they will desperately need. If sea lanes are cut, that is a brilliant trade. They are exchanging fake wealth, digital entries that can be vanished with a keystroke, for real wealth, the kind you can burn in an engine, fire from a cannon, or eat to stay alive. The liquidation of US debt is not the end. It is the funding mechanism. It is the clumsy, costly, but necessary process of turning the paper wealth of the old world order into the physical bunker of the new. The data is clear. The trend is undeniable. A foundational pillar of the global financial system is being deliberately removed. For the average person watching, the question is no longer what is happening, but what do I do about it? For 40 years, the golden rule of investing was the 60/40ths portfolio. 60% in stocks for growth, 40% in bonds for safety. US Treasury bonds were the risk-free asset, the ballast that kept your portfolio steady in a storm. That era is over. The US Treasury bond is no longer risk-free. Its stability is now a political arrangement dependent on the strained generosity of allies. It is an asset class caught in the crossfire of an economic war. So, if the ultimate insider, the nation that built its empire on this very system, is getting out at a loss, you need a new protocol. Let's build one. Rule 1. Shorten your duration. You must understand duration risk. It's a measure of how much a bond's price will fall if interest rates rise. Long-term bonds, like those in a 20-year or 30-year Treasury ETF, have very high duration. If China's exit finally forces rates up, the price of those long bonds will get absolutely crushed. They are the most vulnerable to this buyer strike. Do not hold them. If you need safety and yield, keep your cash in short-term Treasury bills, 1 month to 6 months. These have almost no duration risk. They are nearly as good as cash. Be like China. Get liquid. Get short-term. Do not lock your money up for 30 years with a government whose debt is becoming a political battlefield. Rule 2. Follow the smart money into commodities. China is selling paper to buy stuff. You should consider a version of the same trade. Your portfolio needs exposure to energy, metals, and agriculture. This isn't just a speculative play for profit. It's your hedge against the inflationary endgame. Think it through. If China keeps dumping, and the Allies eventually run out of capacity to buy, who steps in? The only player left, the Federal Reserve. They would be forced to become the buyer of last resort, printing NS of new dollars to buy the debt nobody else wants. A policy called yield curve control. When a central bank prints money on that scale, the value of each dollar falls, and the price of real, physical stuff goes up. China is front-running that very scenario. You should own the producers of the assets China is hoarding. If they're stockpiling copper, look at the major mining companies. If they're hoarding oil, consider the large, resilient energy producers. If they're buying all the gold, owning the physical metal itself is a direct hedge. In this new environment, you want to own the thing, not the currency that's being devalued to buy the thing. Rule 3. Watch the canaries in the coal mine. You need an early warning system. That system is the currencies of America's key financial allies, specifically the Japanese yen and the British pound. These countries are stretching themselves thin to support the dollar. Japan is America's largest creditor, but it is also fighting a severe currency crisis. If the yen collapses further, the Japanese government will be forced to sell US treasuries to raise dollars to buy yen and prop it up. If Japan joins China in selling, the game is over. Watch the exchange rates. If the yen or pound starts to plummet in a disorderly way, it is a signal that the bag holder alliance is cracking under the strain. That is the moment the calm will shatter. That is the moment the Federal Reserve will be forced to choose between a broken bond market and hyperinflation. Your protocol is this: short-term safety, hard asset exposure, and a vigilant eye on the currency markets of Tokyo and London. This is how you navigate the divorce. The number, 688 billion, is not a statistic, it is a timer. It is the most expensive countdown clock in the world, ticking down in the Treasury departments of Washington and Beijing. Every month that it falls, another digit clicks into place. China is methodically, deliberately removing itself from the financial ecosystem it helped create. They are not being impulsive, they are being clinical. They are willing to endure the pain of losses and market turbulence today to achieve a state of financial independence, or what they call financial security, for tomorrow. Do not mistake the current, eerie stability in the bond market for safety. It is not safety, it is anesthesia. It is the artificial calm maintained by political pressure and borrowed time, as allies are leaned on to use their limited resources to plug a hole that is fundamentally infinite. The prop will not hold forever. Economics always wins. When the UK or Japan finally reaches their limit, when their own domestic crises become too severe to ignore, they will stop buying. And when they stop, the adjustment will not be a gentle decline. It will be a violent repricing. The foundational interest rate for the entire world will lurch upward, and everything built on the assumption of cheap money, the housing markets, the stock valuations, the government debt piles, will shudder. The Federal Reserve will face an impossible choice: let the bond market break and trigger a depression, or print money on a scale that makes the pandemic response look timid, guaranteeing an inflationary spiral. This is the endgame China is preparing for. Their stockpiles of resources are their life raft for that coming storm. For decades, we lived in a world of financialization, where wealth was a number on a screen growing through clever deals and complex instruments. We are now witnessing the great rematerialization. A superpower is trading its digits for dirt, its algorithms for aluminium, its bandwidth for barley. The divorce is final. The papers have been signed. We are now in the unsettling, quiet period where the assets are being divided. One side is taking the house, the car, the furniture, the physical things you can touch and use. The other side is being left with the credit card statements and the mortgage note. You must decide which side of that division you want to be on. Get out of long-term promises. Get into tangible things. Watch the flows. The archivist's protocol is active. The next move is yours.